Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm Ed Gotham and welcome to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Today I have the absolute pleasure of welcoming macro investor Diego Parrilla, the best-selling author of The Energy World is Flat and The Anti-Bubbles. In his day-to-day, he's the managing partner and portfolio manager at Quadriga Asset Managers, with a focus on global macro volatility and tail risk. Diego is a really well-versed individual who's also an engineer and economist, which is incredible. In addition, he's also had previous roles managing risk and global teams in prestigious investment banks such as JP Morgan, Goldman Sachs and Merrill Lynch. We have a great conversation deconstructing opportunities from the end of peak oil. What is an anti-bubble and a bubble, and how to take advantage of anti-bubbles, and also gold's perfect storm. Enjoy. Hi, Diego. Good to have you on the podcast.
Hi, Ed. Pleasure to be here.
You're in Madrid, Spain. Is that right?
That's correct.
How's it? The weather pretty good there now? Everything's sort of heating up, at least in the UK. It's got hot again, finally.
Yeah, it's getting very hot here. So summer's approaching, but beautiful. Better hotter than colder.
Yeah.
As far as I'm concerned.
Have you always worked in Madrid? Because I know you've had quite a few different roles over your time in the financial industry.
No, in fact, I've only been in Madrid for about 4 years. Prior to that, I did study my engineering degree in bachelor's and master's in Madrid, but I did my master's in Paris and in the US, in Colorado, mineral economics, and after that, my first job was in London in the mid-late 90s.
Oh, nice.
And yeah, I was there for 11 years. Met my wife, had my 3 kids there.
Yeah.
and then I did spend some time in New York, and then also in Singapore, where I lived for 7 years before I moved back to Spain. So
Wow.
I've had the chance to get to know the world a little bit. Yeah.
Round the world trip.
Yeah.
Now, something that's just happened recently that I thought I would like to get your insight on. The Fed, I believe yesterday, or maybe it was this morning, they announced that they were going to start to unwind corporate bond holdings. Bonds they purchased last year to calm the credit markets, during the COVID sort of problem. From your point of view, what's going to happen to markets off the back of this, if anything, or is it just a bit of news?
No, look, I think clearly the Federal Reserve and central banks around the world have had a response without precedent, both in terms of size, as well as speed, as well as scope, and that included buying things other than government bonds. That fragility of the economy and the recovery, which I would argue the problem was already pre-existent. So we had a pre-existent fragility that was then aggravated by COVID. Basically, it's led to a situation where the central banks have erred on the side of more stimuli rather than less, and that has as we get to see vaccines being rolled out and some glimpses of normalization, it's needed and obvious that you should at least reduce the pace at which you are basically supporting the system. Tapering, as the listeners will now, continue to buy, but at a slower pace, and the opposite, i.e., continue at full pace as if we were in the middle of the crisis. I think it's harder to justify. So starting with the more extreme and basically plans makes sense. And you need to think about, to what extent the market was already somewhat saturated, and those that support was perhaps morphing into another problem. So what you originally intended to keep things afloat perhaps is manifesting or creating excesses in other sides. And this is something that the Federal Reserve needs to balance. So it's inflationary risks with potential bubbles, with support.
Yeah.
And those are things that come into question. So I think it's something that was to be expected. We'll see what the details mean, and what the pace forward is. To what extent that tapering goes from a small reduction to a total reduction or stop, and then after that, if and when you get to see interest rates going up, which would be again that I think is more is a bigger issue than the tapering itself, but based on previous reactions from the market in previous taper tantrums, it's understandable that the central banks are going to be very, very cautious. They don't want to upset the market. But yeah, judging by the price action this morning, it's normal. It's perhaps the first indication of more to come. But I would argue that it's price dependent and path dependent. So if the removal of these stimuli gradually creates a major response in the market, then that may force the central banks to come back and put it again, or not remove it on the first place. And that, I think, is a situation we're in. It's one where we've really blown these bubbles to levels that are by now too big to fail, and the removal of the monetary and fiscal, particularly the monetary, is something that could challenge these valuations and bring us back to the original problem. So it's not an easy thing to navigate, and I think the central banks will be very cautious in the communication and the pace and the size and the scope. But it's something that was to be expected. Let's see how the market takes it.
Got you. Okay. Now, you're a macro investor. I think it'd be really interesting for the listeners just to, from your point of view, to describe how macro investors view the world and how that impacts your sort of investment philosophy, etc.
Sure. Look, I think macro is trading style, more generally top down. Obviously within the macro community, there's lots of different players. I would use the analogy of there are players that are more poker players. So they are betting on short-term moves, the next pair of hands, and with bets that are, a little bit more based on short-term risk-reward and trading and positioning and technicals. And there's a large community of very successful macro traders that operate on that basis. And they just want to know what the next move is going to be. I would argue there's another category of more chess players where I would put myself into, which we are a little bit more medium long term. We are looking at imbalances where, so the way you express your views and you implement your views and you trade has a different investment horizon. And so from my perspective, I take if I was to look at what's happening, I'd like to summarize, the last decade in one line, which is the transformation of risk-free interest into interest-free risk. And that's really what's happened ever since 2008 and, the introduction of QE and monetary policies without limits and, immense liquidity and support. What it's done is really transformed the world from, once upon a time, short-term interest rates at 5% and moderate levels of inflation, which meant, you could park your money risk-free and earn some sort of real return. So not only you made your 5%, it was substantially higher than inflation, to a world where no matter what you look, nominal rates are substantially lower, But when you think about those returns adjusted by inflation, we are pretty much across the board in negative real yields. And this is a new paradigm that has quite deep implications. And as I was discussing earlier, I'm a little bit concerned about the fragility of the system, the artificial setup caused by artificially low interest rates, and what it means in terms of risk and bubbles. And so I think we are in a situation where the artificial valuations, the bubbles, are by now too big to fail. They are potentially systemic. If the support was to be removed, or this fragility to be exposed, we would see that the collapse of these risk markets could create a snowball effect, which we've seen a glimpse of that in Q4 2018 when they had to intervene aggressively. We've seen obviously a very scary move during COVID, and I think this is not over. In fact, I would argue that we are doubled up on the position. And so from a macro perspective, the central banks are in a situation where they are, in some ways, I think we're entering into a new paradigm where these bubbles that are by now too big to fail are the new enemy. So, historically, central banks based financial stability on inflation. And what we're seeing now is a change in the rules of the game. We have a situation where inflation is picking up, and I sincerely doubt that central banks will be able to respond by increasing interest rates, which is what the textbook tells us. It says, look, if inflation goes up, interest rates go up. There's a big problem with that, and it's that if interest rates go up, the bubbles implode, and therefore you are in a very difficult situation that will force you to bring interest rates lower. So why raise rates in the first place? So I think they're in a bit of a trap where we will see inflation increasing and real rates and yields deeply negative. We're already in the -2 area, in depending on where you are in the world, but that's the official numbers. So I think the real inflation numbers are way higher, and they're going to get significantly deeper. And this has dramatic implications for asset allocation. To start, there are certain parts of your portfolio that are going to suffer over the medium long term in the form of major loss of purchase power, and that's cash, fixed income, and credit. Those are assets that have different investment profiles, but they have in common that they're all short inflation. And as inflation goes up, if you have a corporate bond that you paid $100 or euros, that it's going to pay you back those $100 or euros in 10, 20, 30 years, I don't think those $100 or euros are going to buy you much at all in 30 years.
Yeah.
So that's the big issue, and this is kind of this party, this abuse, this bullying, financial bullying by central banks is this party is going to be paid by people who have cash and credit and fixed income. The implications for assets like equities or real assets or anti-bubbles like gold or others, I think it's much more constructive. You want to be in a world where central banks and governments are trying to solve every problem by printing money and increasing debt. I'm very skeptical of that. I challenge that, and that was when I wrote the anti-bubbles, the book. That was the origin. It's like, are we really solving problems? So what's happening here? And my conclusion is that we're not really solving problems. We are first of all delaying them, kicking the can down the road.
Mm-hmm. Yeah,
in the form of debt and passing from one generation to another. The second thing we're doing is we are transferring the problem, so in the form of currency wars and trade wars. So trying to, pass the beggar thy neighbor type of problem. The third thing that's happening is we're transforming the problems, and that transformation is largely into inequality and inflation, which creates a lot of social issues, and we've seen that throughout history. And lastly, you're enlarging the problem, particularly with things like bubbles, etc. So I think overall, this setup is dangerous. There's a lot of complacency in the system. There's a lot of a big belief, in central banks and governments can actually print and borrow their way out. And I think this is leading to a scenario where the world is becoming increasingly polarized. Inflation is on the rise. And I believe, unfortunately, that things either will go into some sort of spectacular blow up if you had a big shock and some of these artificial setup was exposed, and or you have a situation where we have stagflation. So, which I think is the most likely outcome. I think the central banks will continue to provide enormous support in a preemptive basis, trying to prevent the bubbles from imploding, and that setup is not happening with a rosy economy. It's all a bit artificial. So there are perhaps some reasons to be optimistic. I'm a little bit more realistic, I think, with respect to the burden of the debt and the artificial setup, and why I think investors should have caution. And when they think about portfolio construction, they should think in two dimensions. The first one is make sure that you have the right team. So you have I use a soccer or football analogy. You need strikers, midfielders, defenders, goalkeepers. You can't just have strikers, things that will score goals and will do well when the world does well. You need also strategies like the ones I run that are more defensive in nature. So you need that sort of risk on, risk off filter and ensure that you're diversified. And the second filter is inflation, which I think it's on the rise.
Yep.
And so not all strikers behave the same way. Equities, I think, should and will do better than credit. And not all defenders will do the same way. I think anti-bubbles like gold or the VIX will do better than fixed income, for example. So this is a fascinating time for macro. It has very deep implications for portfolio construction. And I think we need to watch carefully as some of these risks might be a lot greater than we believe or appreciate. Yeah.
Interesting to see how macro is more important than ever, probably at the moment, due to its, like the implications we're talking about. It doesn't matter what asset you're in, that it's going to be the macro environment at the moment is going to have a big influence on it. Can you give us a quick overview of what you do at Quadriga?
Sure. Look, Quadriga is we're a 1.8 billion asset and wealth manager. We have overall as a firm, we also have a broker dealer. So we're about 90 people. And what I do in particular is I'm part of the asset and wealth management division, and I'm in charge of a number of teams and strategies. We have two types of solutions, and we're very focused on opportunity and talent. So we have a number of people with a similar profile to mine, very international. For example, one of our newest additions to the team is Christian Thum, who's a former colleague of mine at Goldman and Merrill Lynch, where he was head of prop trading in Europe. And so he's come in with a mandate on the equity long short, which is where he specializes. And then people like me, I specialize in macro commodities, in volatility, in tail risk. And there are multiple other teams that operate, let's say, fully independently. What we do as those teams and strategies, we are following with the football analogy, we play different roles, different positions. So myself, I happen to be the goalkeeper. I'm the strategy that it's meant to do very well in a crisis. We were best hedge fund in the world in February last year, plus 10. I don't know if there's 20,000 hedge funds or whatever, 10,000. We were number one, to my knowledge. And then we also did very well in March, plus 19.1. So throughout the crisis, we were one of the best hedge funds in the world. Not because we're very smart. It's because it's our job. It's our mandate. It's, guys, we need you when things go wrong, and that's the strategy is designed to do that. So that's based on the contrarian thesis of the anti-bubbles, and again, that's helped us gain a lot of institutional and retail support throughout the world with clients, big pensions, insurance, family office, etc. Now, the second thing that we do and that I do is, some investors, at the end of the day, we are solution providers. Okay, this is not the Diego show. I mean, this is the investor, the client show, right? So they are the ones who, when they have savings, they need to decide, what, they are the coach. They're the person who decides, okay, how do I want my team to look like? Do I want more strikers, midfielders, defenders? How do I want to play? Do I want 4-4-2? How do I want to be structured? The second decision they need to make is which players will I use for each position. In some cases, they may be coach and player. They might be investing their own money, or at least a portion of that. And so investors can delegate some functions, for example, goalkeeping, to someone like myself, and then they rebalance the portfolio. They trade. One of the things we do is we've created a solution, which is an entire team, which is composed of our own strategies and also external strategies using artificial intelligence, machine learning, a very quantitative process with human intervention that basically looks to solve what I believe is the biggest opportunity and problem, particularly in places like Europe, which is what do I do with my money, with my cash, with my fixed income, right? Once upon a time, you could park your money and earn 5% without taking any risk, and that investment in bonds or whatever would do well in a crisis, and there wasn't an obvious risk of inflation. Things have changed a lot, and now, if you're my mother, for example, she goes to one of the local banks, and they might offer her something that best case scenario is minus 0.25. Okay, and that's just terrible, because this is a situation where it's costing you money to keep things there. It's obviously suffering from higher inflation. It's bullying people to take more risk, to go into equities, which they may not want. I mean, my mom is in her late 70s. So effectively, the thing is, how do you create a team that will hopefully protect the capital, generate a stable income? We have a target of about 5% above inflation. So how to protect against inflation. And to do that, to build that portfolio, that solution, which is called the Quadriga Stable Return, which we launched with a seeding from one of our major investors, you can't do it in the conventional way, where would you say, well, I just put a bit of equity, a bit of credit, a bit of high yield. This wouldn't work, because you're subject to the risk of false diversification. When a crisis comes, many of these things get hit at exactly the same time. So one of the things we do, in my case, I'm the goalkeeper, but I also help oversee a team, of which I'm the goalkeeper, and it combines all the pieces. And so this is a dual approach. Is individual strategies that people can invest in by effectively outsourcing some portion of expertise, be it equity long short or volatility or gold or whatever. And then the other one is more like a holistic solution, where you can park your money as a fixed income replacement or cash replacement, hoping that we will be able to protect the capital and generate a stable income above inflation, which is something that doesn't exist. And that's what we do. We've done it very successfully. The team, it's great fun. We have fantastic talent. And we're very grateful that the support we're getting from all over the world, really.
And you've released two very interesting books: The Energy World is Flat and The Anti-Bubbles. Could we just dig into the first one, The Energy World is Flat, Opportunities from the End of Peak Oil? What does The Energy World is Flat mean?
Well, the book is inspired, or it takes the title from Thomas Friedman's book called The World is Flat. And this was a book published in the aftermath of the dot-com. And I remember I lived the dot-com crisis in first person. And for those of us who lived through it, the word dot-com it had a pretty bad name. I mean, everybody had a bit of a sour feeling. It's a bit like, I could fast forward and in a few years, what does perhaps crypto sound like, or I don't know, or CDOs, right? Who knows? Maybe they're great. Maybe it'll be a bad word, right? But the idea was that in the energy book, it was an interesting time. It was written in 2013-14. Oil was at 120, and there was a general understood view that of peak oil, the thesis of peak oil, which people thought oil would go to 200, and it was a bit of this perspective, very one-sided. The flattening of the energy world was arguing for a transformation in two fronts. First was the convergence across energies. So it's a bit of and the second was the convergence across regions. So it's a bit of a globalization of energy markets, where historically energy markets were very siloed. So you could be an expert in crude oil, but know nothing about coal or electricity or whatever you want. Yeah. The idea is, throughout, and I went through these flattener forces, and which go all the way down from technology, through upstream, downstream, whatever. Many forces at play that I consider to be flatteners that were effectively driving that process. And it became a book that it was meant to be more of almost like a framework of commodity trading, all the forces at play. And the conclusion when I started the book was clear. By the time I finished writing it, it was even higher conviction. And yeah, it resulted, the thesis has not only survived, it's actually been reinforced by the passage of time. And yeah, it's a world, one of my lines of the book was, and the last barrel of oil will be worth zero, right? And at the time, people thought I was absolutely crazy, because there was this perspective of Mad Max, we're going to run out of oil, and it's going to be worth infinity. And it completely misses the point of technology and many other dynamics across the market. So as a framework, it's been used, it's now used in some universities as a textbook. And I learned a tremendous amount. I had a lot of fun. I co-wrote it with my good friend and best-selling author, Daniel Lacalle. And yeah, writing that book was really, really a lot of fun. And but it touched on a very similar lessons learned with the world is flat, which I think are worth remembering, because they're universal. And what happened then back in the dot-com is we had a game changer technology. So everything starts with some sort of game changer technology. In that case was internet and broadband and things like that, right? If anybody's old enough to remember the world pre-internet and pre-broadband, we still existed. It was just different, right? But so that the expectations built around the new technology were phenomenal. So we saw very high valuations and an incredible amount of money pouring into the markets, right? And everybody was doing that on the basis that they were kind of the only guys doing it. So, oh my God, I'm going to earn €5 per mega of data, and then we literally have the entire oceans wired with broadband, right? So the thing that happened is that we had a huge amount of overcapacity. So after a while, the market, the technology was amazing, the investment was huge, the overcapacity was there, and then what happened is valuations collapsed. Once you had overcapacity, valuations collapsed. But that was the miracle. That's effectively what happened. Is you had this game changer technology in huge size for free, because now all these investments were written off. And so the fascinating thing about the book that really resonated to me was how something that had left that sour feeling to many people, the .com, like, oh my God, it's a fiasco. Actually, the bubble, what it did is accelerated the change. It accelerated the process because you had this huge investment and overcapacity, which meant suddenly that overnight, if you lived in India, you could then be an accountant for someone in LA, right? Something that would have been unthinkable back in the day. And so that transformation, we had something very similar in the energy markets. We had Fukushima happening at the time where we had, in nat gas in the US, horizontal drilling and fracking. And this created a very similar dynamic because we have effectively natural gas available in huge volumes and low prices, about $2 in MMBTU, so $12 barrel of oil equivalent at the time in the US. And the shock of Fukushima, which basically cut nuclear and forced people to produce energy in whichever way they could, including gas, sent it to about $120 barrel equivalent. And so you have effectively the same commodity, Coca-Cola, trading 10 times higher in Japan than the US. And it's not a process that you could arbitrage immediately, because unlike Coca-Cola, which is easy to transport, natural gas is not that easy to transport. It's a gas, and you need either the pipes, which take a long time, or you needed the LNG fleets. And so what happened is this price signal, this bubble, created this ginormous signal of investment, which I at the time of writing the book, I said, look, this is a little bit like the .com. I mean, you have a game changer technology, this huge price signal, and we have this massive investment. So within the next 3 years, you're going to have a wall of supply, and then price is going to collapse, and natural gas is going to be a global commodity. And guess what? As natural gas is a global commodity, you're going to be able to run buses on natural gas, or trains, as Warren Buffett and others did. And we're going to have a competitor for crude oil, which effectively means that the monopoly is gone, and you could see on the margin crude collapsing. And that sort of chess game that I played in my head played out by the letter. Okay, it played out, and many other factors kicked in. And so it was fascinating, and writing the book was an incredible experience. And I encourage everybody listening to us that if they have any interest, as Cicero would say, if you want to learn, teach. I would say if you want to learn, write. And that was fascinating, a very exciting world, very closely linked to macro and inflation and others. And yeah, something I'm really proud of the work we did, and the legacy, that is left, with a number of concepts that are now widely used.
Mm-hmm. Now, I imagine these macro trends are sort of still playing out in the energy market. And is there any sort of ways people can take advantage of these trends in the financial markets?
Absolutely, they continue to happen. I think one of the interesting, frontiers is renewables, right? We talked about that in the book a lot, and this as renewables kick in. I mean, I'll give you an example. For the sake of the argument, I can't remember the number exactly, but obviously Saudi Arabia, as a major oil producer, has been historically a major. They produce their energy by burning crude oil. That was just convenient, okay? And they had a lot of it. They could burn it, and they did it almost for free for their population. They subsidized it and whatever. So a significant amount of crude oil could be burnt for power generation purposes. Now, the minute you can actually produce energy by using solar. You don't need to be a genius to realize that in the desert there's plenty of of sun. Whatever energy you produce using solar means you're freeing up crude oil that could be used for other purposes. So effectively, the development of solar energy in places like Saudi Arabia becomes a flattener because it reduces the demand for crude and makes more crude available for other uses. Okay, and that's why it sort of it's bearish for crude oil prices. Now, what's happening today? I think the world is still, even if the trend is very obvious, in my opinion, which is, in crude oil in particular, we have the civil war between producers and technologies. This is Canadian oil sands competing with shale in the US, with ultra deep and whatever. You also have another war, which is the war for transportation. So people, for the first time ever, to a certain extent, crude oil, when people ask me, why is OPEC being successful? There's a thought or a belief that OPEC was successful because they have an oligopoly of supply. Okay, this sounds pretty obvious. I have the oil, I control the price. Yeah, I'm the big guy. Now, that's not necessarily true, or it's a necessary but not sufficient condition. And there's plenty of other markets where you might have a dominant position, but it doesn't mean you can do whatever you want. And so the real reason why OPEC was successful was not so much the oligopoly of supply, it was the oligopoly or the monopoly of demand. And it's a monopoly of transportation demand. So for decades, we have been driving our cars with gasoline and diesel, and our ships with fuel oil, and our planes with kerosene, all of which are crude products. So the success of crude, the big success of OPEC was driven by the relentless growth in transportation demand, not necessarily for OPEC per se. And so some of these dynamics, which are play, are being challenged because, I myself, for example, we bought our first fully electric car earlier this year, and I can see the ginormous advantages, and there's certainly no turning back, I think, in many ways. And so crude oil has lost its monopoly as it used to be, and you have plenty of other ways in which people can achieve their need. I mean, you need to remember some of the biggest blow-ups in corporate history have come because people believe that people need their product. Whether it's Nokia believing that they need, or Kodak, or others thinking people need my product. No, we need a solution to a problem, and nobody needs crude oil. Nobody needs crude oil per se. What we need is a way, a cheap, abundant, reliable, clean way to transport ourselves from point A to B. We don't need crude oil. Okay. However, many people believe that we need crude oil because they somehow mix this view of I need crude oil with I need transportation. They're different things. And so some of the dynamics that are taking place are, in my opinion, flatteners that effectively challenge this monopoly of crude oil on the demand for transportation demand. And whilst there are other forces undeniable on the supply side, which could counter a little bit of this, I still think that the globalization, the flattening of the energy world is relentless and puts a little bit of a lid to how high crude oil prices could go in the medium longer term. But in the short term, it's all noise. But in the longer term, I think these dynamics and the marginal barrier is very real. And also when situation gets into some sort of crisis, that's often when you see some of these imbalances taking place. The people that are hoarding the producers that are kind of keeping the production away from the market artificially to keep prices high are the same guys that need the money the most in a crisis. And so you have this sort of short gamma scenario where as the market goes down, at $50, I need 1 million barrels to earn 50 million. At 25, I need 2 million barrels. So the lower the oil price, the more volume you need to produce to generate the same amount of money. And therefore, you get these dynamics when as oil goes down, very often you see a significant amount of volume increase because the process reverses. So I think these trends are relevant, are important. It's good to have this big picture framework and then fine tune it with lots of the things you might be seeing, with respect to, more micro dynamics. But I think the big trends are certainly still intact.
Mm-hmm. And so renewables you'd see as replacing over time the need for oil, etc., as they gather steam and more electric cars are around, etc., like this.
Yeah, the energy mix, you will have, what happens is the silos are broken.
Mm-hmm.
So once upon a time, crude oil was just a silo. You had zero horizontal substitution with things like natural gas or others. I think the monopolies are being broken. The energy world is becoming more flexible. There's certainly no shortage of energy. And it's not just fossil fuels. I think renewables will continue to play a meaningful part. And that's good news overall in the sense that we will have, a more abundant, reliable, cleaner, cheaper energy as humans.
Yeah.
And that's good news. So, but I think it's all part of a mix. You will never see, one or the other completely disappear. And I think it's about the right balance, and that takes many considerations. If you're a government or a corporate to secure your energy needs strategically, at the same time trying to optimize for price. But energy security is such a big and important strategic question that it creates generally excess in the system in many forms, storage and others, and production and whatever, that it's is actually bearish long term because of the structural overcapacity you're willing to create because you don't want to run things too tight and then be shocked and run out of energy as a country or whatever. It's not something that anybody wants to happen.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Now, I wanted to move on now to your most recent book, The Anti-Bubbles, which is obviously incredibly relevant, and we touched on it already to what we're going through at the moment in a macro level globally. What are anti-bubbles?
So I always like to start by explaining what a bubble is. And I borrow the definition from George Soros, or my interpretation of it, which is, assets that are artificially expensive based on a belief that happens to be false, what he calls a misconception. So bubbles are situations where the emperor had no clothes, okay? Things that are just artificially high. What I did as an engineer is I generalized the framework, and I said, okay, misconceptions can distort reality, but not only via artificially high valuations, which we call bubbles. You could also have artificially low valuations, which is what I call an anti-bubble. And the concept has three dimensions. The first one is assets that are grossly artificially cheap. It's basically a matter of when, not if, that those valuations will go much higher. It's some sort of value. The second one is assets that, by construction, bubbles and anti-bubbles are like two reflections of the same misconception. They're the same process. So by construction, the moment the misconception is understood is the moment the bubble will implode and the anti-bubble will go up, right? And so this idea is that the anti-bubble is a bit like an antivirus or an anti-missile. It's a defense mechanism against the bubble. It's a hedge. And the third dimension relates to the fact that there's an element of risk premia, being a contrarian. Sometimes bubbles are linked to consensus and excesses. And so in that sense, if you think, for example, at the relationship between the S&P and the VIX, I would argue that they follow a bubble anti-bubble relationship where artificially low volatility feeds into artificially high equity valuations, both through qualitative and quantitative process. So qualitative, such as complacency or the perception of low risk, or quantitative, such as autocorrelated processes with CPAs and vol targeting or risk parity, which effectively tend to buy the most at the top when volatility is low, and then they end up being forced sellers as the markets go down and volatility picks up. So there's an element of being a contrarian, an element of potentially getting paid, because what's ironic is that financial insurance is cheapest when you need it the most. Okay, so the moment when equity valuations are at the highest tends to be the moment where, for example, implied volatility is at the lowest. And so if you think about that, you need the insurance when equities are all-time highs. You don't need the insurance so much when equities have already collapsed by 20, 30, 40%, right? So there's an element of contrarian, and this framework goes beyond the concept. I'm very honored and humbled that the concept has actually taken off. It's been widely used by industry leaders, and following from my contributions to the FT and Wall Street Journal, I think that the word is now being used commonly. So my tiny contribution to, or one of them, to the finance community. But it's also a key ingredient of understanding, artificial setups such as the one where we are today. And all these things like TINA and FOMO, like there's no alternative, and fear of missing out. Yeah, you can take this view that, there are assets that could potentially be part of a team and provide this more well-rounded exposure where, what I would define as strikers and goalkeepers. I think the team is going to be more balanced, and they offer tremendous opportunities. So I think the framework on itself, which is very critical of, as we discussed at the earlier part of the conversation, monetary and fiscal policies without limits and what it means and the consequences and et cetera, is, I think, a very useful framework to try to put some sense into this new setup and new paradigm, which I think it's accelerating.
Mm-hmm. And are there any anti-bubbles that you can see today that people could potentially take advantage of?
Sure. Look, I would say that to some extent, if you want to look for a bubble or anti-bubble, what you need to do is you need to look for the misconception. So personally, and I think, for example, gold is a textbook anti-bubble for the fiat currency, right? And to get controversial here with many of your listeners, I would argue that cryptos are, I wrote this lengthy article with quite a deep analysis on the forces at play. And my conclusion was that Bitcoin was 80% bubble, 20% anti-bubble. So, but this is the result of just going one by one through the beliefs that people use. Okay, you take every single argument, and we can go through it and determine whether, okay, this is a genuinely true argument or whether it's not. And so very often what you find that this happened with the energy book, right? Where we looked at this analysis and said, look, I think these are fallacies. I find, just to give you one, I think the VIX at 16, 17 and equities at all-time highs is clearly a bubble anti-bubble process. Unfortunately, is pretty expensive to buy the VIX in terms of carry. So if you buy this thing, holding it in the ETF is very expensive to hold and carry. Lately, it's been about 10% negative carry per month. So it's a brutal source of wealth destruction. You are in the trade 5 months early, and you may have lost 50+% of your money without any move in the index, just by staying in there. Which means that by the time the move happens in the VIX, you need to double your money just to break even. So it's extraordinarily difficult and expensive, but it's clearly one of the best and most effective defenders you could have when things go wrong, precisely because how difficult it is. There's a lot of people playing the other side. But yeah, I think, look, gold versus fiat currencies, VIX versus S&P, and to some extent, I think also gold versus crypto. One of the fallacies that I've challenged or beliefs that I've challenged is what I call the scarcity fallacy, right? And here people look at Bitcoin and they say, well, there's only 21 million Bitcoins, therefore Bitcoins are scarce. And my argument is, yeah, there's only 21 million Bitcoins, but you can print 21 million cryptos out of thin air, right? Mm-hmm. So Dogecoin is a very good example. I mean, the enemy for Bitcoin it wasn't gold, it wasn't the dollar. The real enemy, in my opinion, is coming from within, is other cryptos that actually show that there's no scarcity, okay? It's absolutely zero scarcity. You can, so people then would argue, well, Diego, fair enough, you could print other Googles or other Facebooks, right? Which leads to potentially first mover advantage, which is fair enough, but I think they're comparing businesses with cash flows with something that is not. It's something more like a piece of art or more subjective. But then there's more interesting models that are built, things like network effect or Metcalfe's law, that sound very sophisticated and which, when you actually understand what they say and how they're used, I think the emperor has no clothes. I mean, network effect at the end of the day is the equivalent of the economies of scale applied to the demand side. So economies of scale, which is a supply side dynamics, is, if you have a factory and you produce 10 units and then you produce 1,000 units, the marginal cost of production of 1,000 units is generally lower because of economies of scale. So that's good. The network effects is sort of telling you that on the demand side, the more demand that there is, the more you're willing to pay for it. Just kind of, and they use examples based on the utility of a network, neural network, or others. Say, for example, very often they use the telephone or the fax, saying, well, if we add more people to the telephone, then the utility increases, which is, you can make so many more different calls. Now, clearly, Metcalfe's law says that the utility of the network increases proportionally to the square of the nodes, which is true. But then there's a major disconnect because they're comparing utility with price. I am not willing to pay exponentially more because there's more people connected to the phone in whatever, mm-hmm. or the company is worth exponentially more. And so I personally, again, I try to be as unbiased as possible. I start that article saying, look, like Frida Kahlo, I don't want you to think like myself. I want you to think. Yeah. and that's what I try to do. And so people are free to look it up in LinkedIn under my name, Diego Parrilla, RRL, and happy to get the feedback. But there are really many things that when you scratch a little bit through the beliefs and misconceptions, you find that perhaps again, the emperor has no clothes. But that's, I think, part of the framework is look for the misconception. If you find the misconception, then you will see things that are artificially expensive and artificially cheap, and perhaps opportunities to find value.
Mm-hmm. Now, in terms of stocks and stock bubbles, you mentioned using the VIX as a hedge against bubbles in the stock market. Can you describe the hidden risks of volatility?
Sure. Look, this is super important. Volatility being one of the key anti-bubbles in the system. I use the analogy of driving a car at 200 miles an hour when the speedometer reads 80. Okay. If, God forbid, you had an accident and you crashed, what do you feel? And the answer is you will feel the real speed you were running, regardless of what the speedometer said. Okay. Now, the markets is a bit the same. Okay. Volatility is a little bit like the speedometer of the markets. You could be long Apple, and Apple is plus minus 1% every day. and you're like, okay, how bad can this be? And then it turns out that one day, who knows, it loses 50%. Okay, everybody will say, Diego, that's impossible. It would never happen. It's like, okay, fair enough. Who knows? But my point is, the real risk you're running is the real risk you're running. And nobody really knows. We can get a sense of what that risk looks like by looking at realized volatility or implied volatility. But what happens when volatility spikes is, a lot of that complacency basically shows up. So as volatility increases, then your value at risk increases. And by construction, all investors tend to reduce risk. Okay, you could lose way more money than you thought. You're kind of breaking your car. And as volatility increases, and you're, through value at risk or whatever, and you are in crowded positions, and everybody's trying to get out at the same time, then this, first of all, reduces the liquidity of the market, becomes a little bit one-sided. You don't have the ability to sell the amount you want at the price you want, the time you want. And this creates, this feeds into, correlation. So everybody has the same trade. And then what you thought you were diversified, but when the crisis comes, correlations go to +1 or -1. So it turns out that when you see the increase in volatility, some degree of forced liquidation, the lower liquidity, that feeds into higher correlations, which in turn feeds into higher VAR, into higher liquidation, creates this very mechanical process where suddenly, this thing implodes. And the market, I use the analogy of fluid mechanics. We tend to simplify the world between laminar regime and turbulent regime. And laminar regime is a linear world, predictable world where things operate the way we expect. A turbulent world is very chaotic. And once volatility explodes, you have the VIX of about 40, you enter this very, very mechanical mega stop loss process that creates this forced liquidation that feeds on itself. And it becomes a snowball effect that is very, very difficult to stop. Mm-hmm. And this is why central banks are so aware of it and scared. See what happened in October, December 2018, that they have to, and they have been preemptively trying to prevent those moves from happening. And so they are now obsessed with not upsetting the market, because they know that if you have these big moves and the volatility breaks through certain levels, that will have a trickle-down effect whereby this forced liquidation feeds on itself, accelerates, and then it becomes really difficult to stop. Because so that is something that I point out. It's super relevant, and I think the dangers of complacency are, you think the market is very stable, things are not really happening, you think you're diversified. So the hidden leverage is risk that you're not aware of. If you're buying, oil futures leverage 10-to-1, there's nothing hidden about that. You're just taking a massive punt and you will blow up if this thing goes 10% or less against you. There's nothing hidden. The hidden risk is one that you're not even aware of. And these are things that happen because, volatility was artificially low, liquidity, correlations were artificially low, and during crisis, all these things move into the same direction. They compound into each other, and they result in major, major losses. So that's why I think awareness and understanding and being able to run scenarios and knowing, that these things can and will happen again. So that's super important, and is a very clear, corollary from the thesis.
Now, as a final question, I just wanted to quickly ask about a tweet I saw on your Twitter account, which was really interesting, about how someone might approach bubbles and anti-bubbles with an options strategy and avoiding leverage long shorts. Could you quickly summarize that? Or
Sure. Look, I think one of the enemies I find is leverage. Leverage is the highway to bankruptcy. Okay, whether it's explicit or hidden. And so I'm an expert in options trading, in volatility, in correlation, and one of the things I say always is it's much easier and much safer to buy options, because when you buy, if you want to bet, let's say equities lower or gold higher or whatever, you could do it in multiple ways. Obviously, a delta one position where just long or short. If you're long, fine, you can only lose theoretically all the way down to zero. You have more upside. If you're short, it's the other way around. But when you buy the options and you spend the premium, you have 100% certainty of what your worst case scenario is. And let's think, for example, at Tesla, right? Let's assume for a second that Tesla is a bubble, and you identified the bubble early, so 2 years ago, and you decided to bet against the bubble. If you had gone outright short, you would probably be reasonably, bankrupt by now, right? Or in very severe damage, because this thing went up, 10 times or more. So, you risk X and lost 10X. If you had bought options, even if they looked expensive at the time, with 100% certainty, you could have only lost the premium. And in fact, maybe you bought puts at 100, and then at 200, and then at 500, and then at 1,000. You've been spending some premium. It's painful, but perhaps eventually those puts, that move from 1,000 to 500 takes place, and you make everything back. So you need to be playing for the long term. You need to be patient, and it's extraordinarily difficult, but at least you know that you can survive, your downside, etc. A common mistake that people do is, these options are too expensive, I'm going to finance them by selling calls. And you're not financing anything. You're long puts, you're short calls, and if this thing blows up, then you're in trouble. And so my point was, the first point I've been making all the time, and this has been particularly focused on crypto, amongst others, but the application is really across any single asset, whether you're long or short, is mind your leverage, because of the hidden leverage we discussed earlier. And to the extent that, you can express those views with options, then if implied volatility is artificially low, happy days, no brainer. Okay, why would you ever think about going long or short outright if you can buy a cheap vanilla option? The challenge often comes from the fact that these options are not that cheap, and that creates this bigger issue and this negative carry. And this is why we do what we do. We specialize in this. It's extraordinarily difficult to be a goalkeeper in this market. And you need to balance a lot of things. You need to balance, your drawdown, your carry, your downside, versus hopefully delivering when the team needs it. And this is a team effort. You can judge the performance of the players individually, but ultimately it's not just how they do on an individual basis, is how they contribute also to the team, right? If Lionel Messi, for the sake of argument, was the best football player in the world, which I think he is, you could theoretically say, well, then a team with 11 Lionel Messis will be the best team in the world. And that would be very, very far from the truth, okay? So in that sense, we all know that a team with a best goalkeeper and strong defenders and midfielders will be better. So you need, it's not about the players, it's about the team. And that team will have parts of the team that are positive carry, others that are negative carry. Some are risk on, some are risk off, some are long inflation, whatever. The ultimate goal is that your team performs in line with your objectives. And to do that, again, what we do with artificial intelligence and other things is to try to create the team that will do what we want to do, rather than hoping. But still, there's a lot of science, there's a lot of art, and yeah, that's something to consider.
Yeah. Well, Diego, thanks so much for the time and lots of insights there that I'm sure people are going to really make use of. Is there somewhere that people can go to find out more about the books we talked about, and also any sort of commentary you have in the markets, keep up to date and your insights?
Sure. Look, we are quite transparent. I think if people are interested in learning more, they can follow me on Twitter. I also recommend that they, contact me in LinkedIn. It's Diego Parrilla, Carrill. And yeah, I think we have a distribution list. We do monthly calls, which we do openly with our investors, and where we share our views, etc. So I think for us, education and sharing the framework is very important. And as I said at the beginning, this is we're just one piece of the puzzle. We hope to contribute to the investors' portfolios, either through pieces that will add value or by delegating the entire team. But yeah, I'll be happy to connect and hopefully add a little bit of value to people's knowledge and understanding and their results, which is also at the end of the day what matters.
Yeah. Cheers, Diego, and again, thanks very much, and I hope to have the opportunity to speak to you again.
It's been my absolute pleasure, Ed. Thank you so much, and much health to everybody. Thank you, guys.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.